IPO scams prove economic collapse is inevitable. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over how the scam actually works. And as you would imagine, it all starts with everybody's favorite entity of central planning, the Federal Reserve. They drop rates down to 0. This completely distorts the yield curve. This is an example yield curve of the Treasury market. Go from 1 month all the way to 30 years. On the left, we go from 0% up to 8%. Prior to the GFC, rates were far more normal. The short end, the overnight rate, we'll assume was close to 4%. And as the maturity increased, the interest rates went up. This makes sense because the longer you lend your money to the government, the more they should pay you, because the more risk you have that they're going to pay you back in cheaper, devalued dollars. And this worked well for pension funds and large pools of money that need a 7% return to meet their obligations. They could just go in and buy 10-year treasuries and they're good to go. But when the Fed comes in and drops the whole curve down, now they can only get, let's say, 1.5% for those 10-year treasuries that they're buying. A big delta between 1.5% and the 7% they need to meet their obligations. This takes them right into the no bueno zone where they are underfunded. They have big, big problems. So what do? They have to go further and further out the risk curve. They have to take more and more risk to get the exact same return they were getting before just by buying 10-year treasuries. And this leads you to the question that would we even have companies today like Tesla, Uber, and DoorDash, this most recent debacle, that's this scam that went public, if it weren't for the Fed dropping interest rates artificially low? If these big pools of money could have sat back and got the 7% return no problem, would they have taken all the risk required to not only fund these companies, but continue to fund them as they burn through cash? It's an interesting thought experiment. But what the pensions did is they went to these VCs. So we insert our new character into the board here. His name is Pyramid Pete, and he is a venture capitalist fund manager. In 2005, his fund, the Ponzi fund, was very small. What they did is they actually looked for companies that had profit potential. Ooh, very antiquated model, I know. But all this capital comes flowing into the Ponzi fund to where now it's triple or even quadruple the size. But Pete has a problem. As the money that's coming into his fund increases, the amount of businesses that are actually profitable, or amount of good business opportunities out there to invest, is decreasing. The global financial crisis has shown us that there's structural flaws with the economy. These didn't get fixed, they just got papered over. As a result, those business opportunities out there are far and few between. So since there aren't any businesses that can actually make a profit, or they're very few relative to the amount of money that Pete has to put to work, he has to come up with an idea. So what does he do? He says, I'm going to forget about businesses that actually make profit. I'm going to focus on businesses that have a fantastic story. I'm going to have to dump a ton of money into these businesses, but when they go public, I'm going to be paid back in spades. The problem here is that when they go public, Pete has to have a lot more money from that IPO than he otherwise would need if it was just a profitable business that was going public to expand their profitable operations. To dive into this further, let's go to a clip from my good buddy Peter Schiff, who really gave me the idea for this entire whiteboard video. He compares Microsoft to DoorDash and Airbnb. It's a fascinating story. Let's cut to the clip.
Microsoft went public in 1986. But when they went public, they were making a lot of money. It was a very profitable software company. And in that IPO in 1986, Microsoft raised $61 million. That's it. Now let's compare that to the IPOs for Airbnb and DoorDash. Each of these companies raised approximately, I don't remember the exact amount, but each of these companies raised about $3.5 billion in their IPOs. $3.5 billion. Microsoft only raised $61 million. Now I know there's been a lot of inflation since 1986. If you take the CPI, which is the government's version of inflation, which I agree understates it, but let's just use the government numbers for the purpose of this analogy. In 1986, this consumer price index was at 110. Today, it's at 255. So if you adjust the Microsoft IPO for the CPI, in order for Airbnb or DoorDash to have raised an equivalent amount of money that Microsoft raised, their IPOs would have been 140 million. Instead, they're more than 20 times that. They're not raising 140 million. They're raising $3.5 billion. What are they going to do with the money? Other than subsidize their existing losses because they're hemorrhaging money. Microsoft wasn't losing any money. It was making money. Microsoft needed that money to expand, to take a viable business model that had proven to be successful and to expand it into a much larger company by tapping into the public markets to raise capital. DoorDash and Airbnb don't need to tap into the public markets to raise money. They've already raised billions in the private VC market. That market didn't exist in the Microsoft days. It exists now. And in reality, the only reason that we have IPOs today is so that the VC investors can cash out, right? It is not so the companies can raise new money to expand. They've already raised all the money they can. They've expanded the businesses as much as they can. And now they want a payday. But the one thing they haven't expanded is their earnings because they don't have any.
So once Pete finds a company with a good story, he then has to hire a couple other individuals to create all the hype required for a huge IPO. So he looks for his buddy Dog and Pony Show, Bo. That's right. In his cowboy hat and most likely his cowboy boots that I didn't even want to attempt to draw. But he is the CEO and he can sell ice to an Eskimo. That's right. Then the last piece of the puzzle is creative accounting, Ike. And I have no clue where I got that name, but Ike can really fudge the numbers. In fact, he can create all of these new metrics that make the company seem like it is wildly profitable when you actually look at the bank account and it's incinerating cash. It's a very neat trick. So they go on their Dog and Pony Show and they create all this hype, and Pete just keeps pumping more and more money into this company that is basically selling $20 bills for $10. As you can imagine, their revenue is skyrocketing. The media buys this hook, line, and sinker, and you throw in some social media echo chamber, and all of a sudden, they have a huge IPO. Plenty of money to cash out and make Pete a very, very rich person and pay off those pension funds who need the 7% return. Again, none of this would have most likely happened if the Fed would not have dropped rates down to 0%. Let's keep that in mind. But another example of how this looks is WeWork that almost went public, but didn't quite make it and then completely collapsed. To check that out further, let's go right back to the internet. This article was written just prior to WeWork's IPO collapsing in on itself. The New York-based company will test public investors' appetite for cash-burning startups. WeWork lost $1.9 billion last year. Uber, however, lost $5 billion in just the second quarter. Let that sink in for a moment. More than just its cash-burning ways, WeWork's IPO will test investor tolerance for made-up accounting metrics as well. You might recall community-adjusted EBITDA. the gauge WeWork devised to measure net income before not only interest, taxes, depreciation, and amortization, but also building and community level operating expenses. So basically what they're doing is adding back the majority of their expenses, somehow claiming as though it's equity or goodwill, I'm not quite sure, to make it seem as though they're not burning through the billions and billions of dollars that they're burning through. This is a great example of creative accounting, Ike's creative accounting. Step number 2, how does the retail investor play along with the game? In step number 1, you're probably asking yourself, well, if Pyramid Pete is creating these story companies that really don't make any money, doesn't the retail investor see right through the charade? And we look at specific companies like DoorDash that Peter Schiff talked about in his most recent podcast. How can anyone invest in this company that is just burning through money? Editor, go ahead and throw up the data from Yahoo Finance and you'll see what I'm talking about. But when you look at their competitors, such as Uber, you'll see that it doesn't get much better. In fact, they lose a lot more money. And then we look at Grubhub, their direct competitor, and they incinerate money as well. So how does the average Joe fall for this nonsense? Why does he go in and buy these companies that are hemorrhaging money? If we think about what influences he has on him today, it starts to make a lot of sense. For the last couple decades, it's been ingrained into his head, there is a Fed put. So always buy the dip and you'll make money. He turns on the TV, sees CNBC, and all he hears is buy, buy, buy. Buy, 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 buy. He looks at the government, and the government is saying, don't go outside, don't open your business, don't walk on the beach. There's danger everywhere. We want you to lock yourself in your house, and we'll pay you to stay there. So whatever you do, don't go out and start a business. No way. That is way too risky. He looks at the real economy and sees very few opportunities. It's not like it was in the good old days where you could go out there, work hard, and get ahead. Now the only way to get ahead is to buy assets and hope they go up in price. He then looks at his Instagram account, and everyone he follows is getting rich buying stocks. He's looking at their Lamborghinis. He's looking at their travel lifestyles. And he's wondering why on earth he isn't doing the same. Then he looks at his other social media accounts. And of course, he follows people that have the exact same belief system he does. So it creates this echo chamber where he doesn't hear anything outside of the facts that he wants to hear. This creates tremendous FOMO, fear of missing out. And all the people that he follows say not only buy the dip, but you should buy XYZ asset. You should buy Uber. You should buy DoorDash, buy Airbnb, and you're going to get rich just like me. And lastly, DoorDash is one of these brands that so many of the young retail investors right now have experience with. Think about it. They're locked inside their house. They can't go to the store without putting on a hazmat suit. So of course, they're going to get the food delivered. And the delivery driver shows up. We'll say it's Moody in their Prius. And Moody is driving for DoorDash. So it makes sense. Every single time you get food, you see the brand. Therefore, the average Joe thinks the brand is huge and printing money. And to be fair to Jim Cramer and CNBC, I know I poke fun at them all the time, but I did find a clip that I think sheds some more insight on the psychology of what's going on with the average Joe, these IPO scams, more specifically DoorDash. Editor, let's cut to the clip.
Well, look, the one thing is certain, Carl, is that this newer brand of investors I've been profiling on Mad Money have a lot of capital. A lot of people say, well, where did it come from? I don't want to even ask that. I just say they like things. And when they like things and they use things, actually the old Peter Lynch model from Magellan Fund for a long time at Fidelity, they're willing to keep buying. Look at Snowflake. I mean, when I speak to Frank Slootman, he's not sure exactly who his investors are, but he knows a lot of them are retail investors. DoorDash is used by a lot of younger people, both in the suburbs and in the cities. So I think that you're going to see incredible enthusiasm. I wish that people would use limit orders, but that is a parlance, Carl, that they don't understand. They don't get that.
You combine this with the dog and pony show that we talked about in step number 1, along with Bo and Ike. And then we also have to remember that since 2008, the banks have been expanding their balance sheets almost exclusively to lend to big corporations that go out, take that money, go into the stock market, and buy their own shares back. Editor, go ahead and throw up a chart of shares outstanding for the S&P 500. And we can see it's gone straight down since 2011 as corporate debt has climbed to all-time highs. I want to show you one more thing I found on the internet while doing research for this video that really tells the story. People whose Facebook friends experienced a 5 percentage point larger house price increase over the past 2 years are 3.1 percentage points more likely to transition from renting to owning. Will pay 3.3% more for a given house, make a 7% larger down payment, and buy a 1.7% bigger house. This shows us how dramatically outside influences impact our decision-making process when it comes to investments. And it gives us insight as to why the average Joe is so susceptible to buying into these IPO scams. Step number 3, the end game. And this is where we need to talk about natural selection and how it applies to the economy. In steps 1 and 2, I'm sure you're following along, but you might be scratching your head saying, George, okay, I get it, but how do these IPO scams lead to an economic collapse? And here's how I think it happens. Just like natural selection in the evolutionary process, the strongest survive. Their genes continue on to the next generation, making the species as a whole a lot stronger. It's the exact same thing in free market capitalism and the economy in relationship to profitable businesses that create goods and services. And I want to take us back to some of my more recent videos where I've outlined what exactly is wealth. Is it just green pieces of paper? Absolutely not. Wealth in the society is the amount of goods and services the society produces. So if we are funding all of these companies, let's say now instead of funding the strong companies, we are funding the weak companies that don't really produce any goods and services, or they might just produce them temporarily, or they can only produce them if they're subsidized. What these companies do well is they produce great stories, but they produce them at tremendous losses. So if we're propping up and funding all of these businesses that, again, can't produce goods and services sustainably, the only thing they produce is a $20 bill they sell for $10. Over a specific period of time, you have fewer and fewer companies that are out there that can produce goods and services and create the wealth of the society. It's just like the giraffes that are out there on the savannah trying to eat leaves from the trees. What we're doing right now is funding the short, fat giraffes when we should be funding the tall, thin giraffes with the long necks that over a long period of time will be able to survive. So this whole process works in reverse. And what you end up with is instead of a strong economy, you have an economy that over the long term becomes weaker and weaker and weaker. And no one points this out better than Milton Friedman himself. The economic miracle that has been the United States was not produced by socialized enterprises, by government union industry cartels or by centralized economic planning. It was produced by private enterprises in a profit and loss system. And the losses were at least as important in weeding out failures as profits in fostering successes. Let government prop up failures, or in this case, venture capitalists, and we shall be headed for stagnation and decline. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.